Hey guys, thanks for happening upon my channel. I typically do blockchain and altcoin videos, but this time with GME Gamestop required a special video, especially with Tomash and a bunch of other leaders in my space that are on everyone's lips talking about it and them tweeting about it and making such a big deal out of it. So I think I felt compelled to make this to give a little bit of a foundational understanding of what's at play here. I've spent some years in private equity and then was an options trader over a decade ago. So I have an understanding, I guess, maybe more than the average person on the street as it relates to this topic. So I thought that I would just kind of break down exactly the who, what, where, when, and why of this and what's exactly at play, and then kind of how I see this turning out. Please understand this is not financial advice. Take everything that I say with a grain of salt. I am an analyst. So Gamestop, GME, it's front page of New York Times, Wall Street Journal, CNBC. It's all everyone's talking about today, yesterday, and for, I guess, the last few days. And it revolves around not only the growth of GameStop and how they're doing phenomenal things in terms of switching it around with the new leadership team, with a previous CEO from Chewy, but also how the really popular forum Reddit is involved. So for those of you who don't know, Reddit is like at this point, a top 5 site, maybe on 6 or 7. But the founder is married to Serena Williams, and he did a great job of bringing people together in this really easy to use forum where you can easily put in emojis, and they have communities around different interest groups. So the one that's getting the most attention is Wall Street Bets. And if I had to characterize the subreddit, it would be, young people that are enthusiastic about tech, about finance, about ways to do it intelligently, and get big movements on either side. So they do use a lot of options, and options are a tool where you can control a good number of shares for a small price. And usually you pay what's called an option premium, or a little bit more than what you would if you had to borrow it directly from a stock brokerage. So there's this thing called a meme stock, and on there people will do a meme about Blockbuster, for example, and Blockbuster, going under, the meme will be like, oh, I remember the good old days when it was the biggest thing we had to worry about was be kind, rewind. So that'd be like a funny little meme. And then in the case of GameStop, there's a lot of nostalgia associated with this company because for many people in their late 20s, 30s, 40s, it was a good place where they would go and spend time on the weekends with their friends buying games, trading in games, and there's a lot of positive emotions associated with that. And then if you've looked at the stock, because of the prominence of Amazon and all the solutions online that can be delivered, next day and are really inexpensive, the price went as low as $257, and as the analysts that I read actually calculated that to about $23,000 a location, and those places actually do fairly well, especially on the pre-owned games, because they buy them for next to nothing and they're selling them for $5 to $10 a pop. And they do get a good margin from the new games as well, especially with the pre-releases and those promotions they get from Activision, Blizzard, and all the big companies that are trying to pump their game. And let's face it, we're entering an e-gaming era, and a lot of the people that are in blockchain are also have their foot in the door in e-gaming and all sorts of other new industries. So the meme stock that actually becomes the story, and that's essentially what happened. The growth of this subreddit has been astronomical. I think it was 1.7 not long ago, and now it's over 3. And I think even over the last few days, it went from 2 to 3, which for a Reddit, 1 million people is quite a lot. And I think out of those, a great many are coming to the platform for the first time. So that's exciting to see. But what has brought a lot of people to the subreddit is people are trying to profit off of the price of GameStop. So what brought it here? Well, it was a lot of short selling by hedge funds and people that are trying to use the actionable intelligence of everything's moving online and you don't really need to be in a palpable situation or hold on to gains, or the brick and mortar aspect of gaming seems to be fleeting. So they thought that this is a good opportunity to go short on it and make a profit from when the stock actually goes down by borrowing it from retail investors. So essentially, for people that don't know about how short stocks work, you go in, and if through Interactive Brokers or E-Trade or Ameritrade, all these solutions, if you borrow even $1 against your stock holdings in the terms and conditions, you have to give the brokerage the ability to lend out your shares. And what that means is that, let's say a share is worth $100, and if you lend it out to someone and it goes down to $20, then they would just have to pay you $20 to get that back, because they would buy it back on the open market. And then that 80% difference or $80 difference would represent that arbitrage or that profit. So there's an interest rate to do that, which is usually 10%, 20%. It varies on a day-to-day basis when it's calculated. But unless you're a large trader or with Interactive Brokers or one of the larger ones that do offer some concessions to retail traders, you're not going to get any of that. So if you go on Interactive Brokers and you have an account there, it's really shocking to see how much of a return you could actually get from getting a piece of that short interest. And over the course of the S&P 500, of course, dividends constitute a great, I wouldn't say a majority, but a huge chunk of what the earnings are. And if people could earn more than the dividends for a stock by getting something that's, that you're interested in, it's going to, or you think it's going to go horizontal, but at the same time you could lend it out for that short interest and earn something from there, that's a really powerful compounding tool. But at the present time, the subreddit people have been doing a bunch of memes. One of them is, I like this stock. And, they'll do, I like this stock, I like this stock, I love it. And then just kind of like build that momentum. And they'll do funny memes around it, and people are kind of rallying around it. So what people did a little bit of research on it, it started with this one guy that did a pretty in-depth fundamental analysis of GameStop. And it showed that there's a significant short position on it. Actually, over 100% of the shares are being sold short. So what that means is that when you lend out a share, those people that have those shares that they were borrowing will actually lend it out again. So it's kind of hard to wrap your head around, but what it represents is that when it goes up, or when there's naked option selling and people want to cover their positions, they'll actually have to buy the opposite side. So these people that are significantly short GameStop are eventually going to have to sell it. And when you buy something, that increases the demand. So that further pushes on to the demand from the options traders and retail investors buying to the shares directly. And that pushes it up that much more. So at the present time, the short sellers, which are majority hedge funds in Greenwich, Connecticut, New York, that sort of thing, are $6 billion down on their short sale of GameStop. And there are a few hedge funds that are very vocal about they're not liking it. People which being Melvin Capital, and he went short when it was double digits. And now that it's triple digits, he actually had to reach out to some of the larger hedge fund leaders, like Ken Griffin and Mark and Steve Cohen, which are the 3 and 4 biggest hedge fund people in terms of net worth. So he really went into his Rolodex and was able to get, bailed out, get that additional liquidity. And therein provides some of the friction that you see. A lot of the people that are on Reddit, these are normal people that are tech savvy but are also interested in investing, a lot of millennials, and they're looking at the bailouts from yesteryear, that started Bitcoin in 2008, 2009, and then with the stimulus and everything, they feel out of the equation with a lot of the bailouts. So they look at this situation of this hedge fund guy, lost 30% of the return of his fund because of this naked shorts position. And he has people to bail him out because they understand that he as an investor has some good long-term potential and can do another fund and get some sort of coverage that way. But I think it left a lot of people with a bad taste in their mouth regarding these hedge fund managers. So, and it also brings down the understanding of why do we trade and how do we arrive at the valuation that we do. So there's momentum trading, and then there's value investing trading. And for value investing, there is the Graham Dodd technique, or Benjamin Graham and Warren Buffett, I suppose I should say, where you're looking at how does this reflect its value in terms of a business. If I went to a business broker, Sunbelt business broker, and I looked at the financials of the company, and I'm saying, will I be able to get my return on a fairly short period of time? Will this actually increase in value? Is this a diminishing asset? So Warren Buffett is always big on taking a stock and looking at it as though it were a business that you own, because in Berkshire Hathaway, in his own portfolio, he just has the existing managers stay there and continue to build it up. And so, there's additional factors at play in terms of stock buybacks and dividends and things that are structured a little bit differently because they're all in C Corps. But it's an interesting way of looking at stocks, certainly not applicable to, let's say, 2000 dot-coms or a lot of the blockchain companies nowadays, or a lot of SaaS companies that are extremely growth focused. So having a valuation that is looking over the 10-year horizon of the company isn't really too applicable, because a lot of these will either scale or crash and burn in a few years. So you can see that the low over last year, this was about 6 months ago, is 257 as opposed to the high, which was today, of 380. So anytime you're over 100x, there's a lot of volatility there. And in terms of the actual value metric, if we even go that route, there are some positive cases that GameStop could represent some value. You have the Chewy CEO that's on there and talking about how there's real value to be able to milk that existing good feeling regarding the stock, and that they can go a number of different ways with the popular website and with a lot of the popular tie-ins with e-gaming. So that has the potential to turn things around, and he's well-funded and has many contacts that are well-funded that could push things up and make use of their existing contacts within e-gaming. So I think that if you talk about the building up of the company, it has some real value at that earlier valuation of 23,000 location. These are some flagship locations that are in some of the best parts of town, some of the most used malls in America. I know that increasingly malls are used less and less, but still having those premium locations, those are signed under some very positive lease terms that have long-term value. And I think that there's a serious case for fundamental analysis, but really what's in the news nowadays is the actual momentum. Say flow over pros is one of the big calling cards on Reddit in terms of how does one invest. They see the upward momentum. They see that these short sellers are eventually going to have to close their positions, and they're like, how can I get a piece of that other side and hold on for the ride between then and now? So in my industry, Chamath Palihapitiya is one of the biggest, most prominent people in blockchain. Certainly he was one of the people that was a bull of Bitcoin forever ago. We talked about it on Squawk and CNBC. Has been involved with and interfacing with investing with Bitcoin since 2012. So he has a lot of time in the game. I got in 2014, but he has infinitely more connections. He's as sharp as they come, and really savvy when it comes to tech. So what's interesting about this story is that he threw his hat in the ring in terms of supporting the Reddit community. And when he was called under the carpet, essentially, of Squawk Box, talking about how the analogy of Redditors being kids or unsophisticated investors, I think, is with a broad stroke, as he said. And I think that's fair. I think there is a lot of good fundamental analysis going on there, but there is also some fun. I mean, if you look at the trends of 2000s investing, they're just looking for Ballinger bonds, and they're looking for metrics like, is this going to go down? What's the interest relative to the demand? How much is floating out there? And essentially, it's a calculated risk every time you do an investment. So the fact that these people are relying upon more intangibles and relying towards the momentum, I think it's not necessarily bad, as he says. To malign that type of investing and that type of metric is foolhardy, and because it's done fairly well. And certainly, people that have been involved with it have rode the ride up, understanding that this type of attention and anything that bucks the efficiency model of the market as baking all the information in is noteworthy and will get that much more attention. And if we dispel the notion of the efficient market, which I think majority of stocks do have all the right information baked in. But if they recognize that other factors are in play, and then everyone starts to recognize that, and there's a huge shoot up from the short selling, and from that understanding, then they can start to do well. And numerous people on the subreddit have done well. So I guess they're paying themselves for their forethought in that area. But he did. For one of his charities, he bought $100,000 worth of GME options. And then the next day, today, when it doubled again, he went ahead and reserved all that for the charity. And now they have $500,000. But I'm a big fan of his taking the side of the retail investor with his VC company that he has over $1 billion worth of assets in social capital. He takes a positive look towards bootstrapped companies, of all the VCs that I know that are the most prominent, from Stanford and the most well-heeled institutions in America. They all look to him. There was a group in Clubhouse, which is a new app, and they went down the line in terms of the VCs. Who do you follow? And the most common one was Jamash. So I think that speaks volumes when some of the biggest VCs are looking to see what Jamash has to say as it relates to not only VCs, but blockchain and then investing. And then, he's running for governor of California, I saw. So the influence is wide. And then in terms of influence, Elon Musk, it's hard to get much more influential than the richest man alive, right? So he did a tweet about Wall Street Bets with a direct link to Wall Street Bets. And he has, I think, 45 million followers. And certainly people appreciate his acumen as it relates to business, innovation, and tech. And so I think that those types of people immediately started to go into Wall Street Bets. And that starts to build up the FOMO, the fear of missing out. And that helps things grow that much. But the narrative, as it's been relayed through the media and then certainly through the Redditors, is that it's these two individuals that are more seen as egalitarian versus the Greenwich Crew, hedge funds, Harvard Bullies, Network, that sort of thing. And it's interesting to see those who straddle the line, like the Winklevoss brothers, right? So they're big into Bitcoin, they have the Gemini project, and they can toe the line on the blockchain and egalitarian side. And then, because they're against fiat and they think there's too much printing going on, so they recognize that libertarian argument. But there's also, they're part of the Old Boys Network. They know all the Facebook guys. They know people from Harvard, and they know the traditional hedge fund managers, Ken Griffin and all those guys. So I like that they're coming out in support of those types of initiatives of supporting the retail investors, because I think that the overarching narrative is that there needs to be more fair rules and accountability across the board. Because what you're seeing in response to what's seen as the market manipulation, the stocks going down much higher, is that there's a lot of calls from the top in terms of regulation. So already we're the most regulated country in terms of margin requirements. I think if you have a regular trading account at E-Trade, you can borrow another like half, right? So if you put in 1,000, you'd probably be able to borrow $2,000 worth of shares. Now, if you have portfolio margin in the US, you need about $125,000 for that. You can get a real-time calculation, and that gives you, more margin. But I think what a lot of people are doing is they're recognizing that through futures, you can get margin of 500x, and certainly through options for low implied volatility stocks, that with just a little bit you can piecemeal out quite a bit of leverage. And then at that point, you're just looking at what's called delta. And if you can see that the delta is high enough, you can go, for a few pennies really to get some sort of delta, which let's say you have delta on Johnson & Johnson. Then that means that when Johnson & Johnson goes up, let's say $1, then you have a representative piece of that. So let's say it's, delta 5% or 0.05. Then you'll get, 5 cents when they go up. But there's also the considerations that go into that. But what people understand outside of America is that leverage is being used by everyone. And a lot of the people in the subreddit think that leverage is being exclusively hoarded for people that do hedge fund trades, because you have a lack of accountability. If everything goes belly up, then you have a long-term capital management situation, or it's the sort of situation with a big building where it's like, if you owe, $1,000, that's on you. But if you owe like $1 billion, that's on them. And then when a bank goes belly up, of course, they have to be figured out, not by the person that started the bank, but by the regulators. And then when they hand over the savings and loan, it's kind of like, here's the toxic debt, you figure it out. So there's a lot of feelings like, why is this being reserved when these other people can use them? And with a lot of these products, especially going short and everything, there's a real feeling about the dual nature of stock manipulation, right? So a hedge fund can go short, and this happens with hedge funds. They went short on Herbalife or any number of other companies, that they'll go significantly short, naked short, which means that they just put a little bit down for the margin, and then if it goes in their favor, they make a lot. But if it goes the other direction, it could go, the amount is infinite. The stock could go to 1 million, and then they owe, billions of dollars. But in those cases, they would actually fund, and it's widely done, is they'll fund reports and press briefings and contact influencers that will malign a stock, because it's in their best interest to do so. When you do that, you sow the seeds of doubt, and then people either sell their gains, cash register based on that uncertainty that's being introduced, or they themselves will piggyback on that and short sell it. So what's that based on? Well, it's based on a report that one institution pushes out, or they, through some proxies, will push that out. The difference is on the subreddit, the transparency is all right in front of you. Anyone can go to reddit.com/r/Wall Street Bets and then see what everyone's talking about, see the memes, see the discussions, and it's all very transparent. So the manipulation is, I think, more of a free flow of ideas, just the same way that $TSLA for Tesla on on Twitter would amalgamate information about Tesla. So it's like a bunch of different voices communicating. And then if they want to come in with the argument that this amalgamation of users represents a media format, then certainly that's an argument they could present. But I think that I'd rather have all those voices in there rather than one actor that's going to benefit themselves exclusively. And they have the keys to understanding who their touch points are to release that information. And so I think transparency when it relates to the internet is always appreciated by the end user. But so I think that the bad actors, in the cases of pumps and dumps, are certainly the promoters that go in there. And just like a penny pump and dump, you can see the money being spent a lot of times with the promoter, and then recognize that it's going to get sold. A lot of their value isn't there. But not that promotion is necessarily a bad thing, but that in those instances of the pump and dumps or the reverse pump and dump, which is selling short, that there's just a few people that are benefiting and they have that privileged information. So I think a strong case can be made that they're the bad actors, or that they themselves are manipulating much more than a collective community that's amalgamating information and data and saying, what about this? And then challenging theses and having an open discussion about a particular stock. And then this momentum, writing it up and obviously getting excited about that. There's nothing, I don't think, juvenile about being excited when a stock goes up. But that also comes back to the question, which I think a lot of people would immediately answer yes, of is a stock being sold short bad? Because you think of the people in their retirement plans that have that stock, and they're, I guess, being robbed against by the stock going down. And a lot more people are being hurt than are being helped when a stock is being pushed down. And then it does take a lot of capital to push a stock down like that, even with leverage. But you also will consider that what brought down Enron, it was that short selling. It was that inquiries looking at all the short interest. And then, do these numbers match up? Does this make sense? So in terms of an actual health of the company and the transparency being afforded those retail investors, I think that the short does have a place in terms of keeping people honest and accountable. But certainly it's unpopular for many people that are holding that stock, and a lot of boards feel held hostage by corporate raiders coming in there with green mail or all these offers for really restricted terms on coming in with additional money, or they're going to short. So it's a difficult road to go down. And I think that being a short seller is a delicate game to play. But with brick and mortar businesses, a lot of the fundraising will be based on how well their stock is doing. So now obviously, because it's at 380 or 350, they're going to be able to raise a lot once it kind of stabilizes. But if the stock was still at 257, the ability to raise more debt or do an additional offering that would water down that price is going to be less well received than if it's a triple digit stock. And I think that the overall insight of people being experts and being like, well, I worked at this quant trading firm, or I worked at this fancy place that gave me those MBA skills, I think has certainly some value, but I think is too quickly taken over or seen as that much better than just pure research, and then a lot of information that's easily accessible on the internet. So if you venture onto Wall Street Bets, you can see that some serious research is being done, and a lot of it is very compelling, and a lot of the points are made very succinctly. And I think there's a lost art of when you see a research report, you pay $100 for it, and it's a lot of math that goes on, and a lot of the points I think are put in there as filler. So on Reddit, certainly there's no attention, there's no patience for filler. You got to go to the point, you got to deliver the meme, you got to deliver the point in the message, and you'll get a counter argument. So I think just having things in that less elegant short form shouldn't necessarily be looked down upon. I actually think that, what do they say? That if you want something written well, then write it in short form. What is it? If I had a few minutes, I'll write it in long form. If I had it an hour, I'll write it in short form, right? Because it's like you have to distill something down into more of a nuanced form. So, in this situation, who? GameStop. And of course, the Wall Street Bets Reddit got that much bigger. And then we have a more nuanced view of hedge funds and kind of how they operate on the sell side. And then the short squeeze, which is, I think, currently 140%, and understanding that there's such a aggressive stance on short selling this stock that people want to, or at least the hedge fund managers wanted to squeeze as much return as they could out of it. And now that they're caught in a position where there's a tremendous amount of upward pressure, that they're kind of like, oh no, I'm going to have to buy back those shares. And then these people are holding on, at least they purport to, all the way to 1,000. So that would bankrupt all these, or at least a number of these hedge funds. And it's kind of like with the existing losses that are unrealized being sustained and being a drag on the overall ability of the hedge fund to perform, is that something they want to continue to entertain. So they may pull out of helping Melvin Capital, and a lot of these hedge funds may hang the guy out to dry. So you never know kind of the way that they'll go. But it's also an interesting analysis of retail FOMO. Like, there's nothing wrong with being excited about a stock and going up. And then the fact that more and more people are going into options, I don't think it's necessarily a bad thing. Like, if you use options well, then you can get a deep in the money option for a stock, for example, that's relatively low in terms of volatility, and then 70% of it, 80% of it, you can put in the bank. And you have the coverage on that stock, which would be the same as if you own stock. And then with that additional money, let's say that the stock goes from 100 to, they find out it's like an Enron situation, it goes to 0. Then you saw that 80 in the bank, and you just lost just that 20. So it's a risk mitigation tactic that people use, and it's can be used intelligently, and it's not just for getting Tesla at 1,000 and hoping that with the long-term equity appreciation potential option that it'll hit. They have those certainly, but that's there's many ways to use options. And then I think the most compelling things and the things that social media loves is seeing billionaires at war. Chamath and Elon throwing their support to Reddit and giving links to it and talking about it and going on CNBC and indulging people and kicking back their traditional investing community, I think is really compelling. And then, the double standard between, well, certainly a lot of them know the regulators, but between the bailouts that are given to people that own the banks or the hedge funds and have seemingly unlimited sources of capital versus what's being attempted to be inflicted on individual users for talking about their excitement about a stock is really telling. I think rubs people the wrong way. But you see that the overall narrative of, I think, income inequality and regulation being selective, and then who can profit from this short squeeze and what's the ramifications going to be. A lot of the people on Reddit think that increasing regulation is going to be implemented under the guise of the stability of the U.S. market. So I think that the overall narrative when this comes down will be that fundamental investments are okay, but momentum is seen as foolhardy. And then leverage is okay, but only if it's used by accredited investors, say, who are termed people that I think have over $1 million in assets, and then over the last 3 years made $200,000 at least in 2 of those years. So for some reason, even though you can go to the gas station and buy a lottery ticket, the SEC think that you can't handle your money with more speculative instruments like additional leverage more than 2x or 3x. So whether the new SEC chair will go in there and do some sort of broad sweeping legislation will be interesting to see. As I remember it, he's from MIT and he did some classes on cryptocurrencies, so I think that he's fairly open to the ways that finance can transform an economy, and it'll be interesting to see. But thanks for checking out my video, and stay tuned for more information on GameStop and Wall Street bets.